in the next few months, we're going to see the non-farm payrolls getting worse and worse. You'll see the blips up and down, and then they'll be revised and so on. And all of a sudden, you'll see the stock market will put in a top. It can be at a very high level, and you can see the euphoria develop, which is, I think, we're going to see. You think Bitcoin can go to 160,000, and you'll see people be euphoric and thinking, okay, I'm a billionaire or a millionaire, or how much they will become. And everything is fine, but that's actually not fine. And it's not fine that the central banks are starting to ease, because that they only do late phase and late cycle, because they are always late and they can't save it.
What's going on, guys? Today we got a great episode with Henrik Zeberg. He is the head macro economist at Swissblock, and this conversation is an absolute doozy. We talk about the macro outlook. We talk about the K-shaped economy, inflation, why he thinks a big tech bust could be right around the corner, why the 4-year Bitcoin cycle, it ain't going anywhere, and why Henrik actually believes that people holding risk assets may not do so well in the coming months. This conversation is going to challenge a bunch of thoughts that you have about the market, about where we're going, about Bitcoin, gold, tech stocks, and much more. Make sure you watch the entire thing, because he lays out a compelling argument, and I'd love to hear whether you agree with him or not. Here's my conversation with Henrik Zeberg. All right, Henrik, I thought a great place to start this conversation. There's a lot of people who believe right now we are actually early in a macro cycle, that there's still plenty of room to run. It seems like you think that we are towards the end of a cycle, and actually people should be very cautious right now. What is the difference of opinion, and why do you think that maybe we are closer to the end than we are to the beginning?
Well, first of all, because there's absolutely no indications that we are early. I mean, if you look at the one thing that when central banks are starting to ease, that they don't do in the early phase, they do that in the late phase. They do that because the economy starts to deteriorate. If you look at the job numbers, we just saw the correction also right now. You don't see that kind of deterioration into an early phase. You see that into a late phase. If you look at the consumer confidence, you don't see these kind of level into a recovery. So we are nowhere near an early phase, and again, it's the pieces of evidence are out there, and if you look at it, it's you also start to see the short-term yields declining, and we have the topping of the long-term yields, which is also normally what we see into a late phase. So there's absolutely no indication of an early phase here, as I see it.
So one of the frameworks that I use is there's a natural market cycle and then there's an artificial market cycle. The natural market cycle is kind of what happens when you have normal interest rate levels and people are kind of participating in the way that they normally would participate if humans weren't intervening in the market. As you mentioned, we get to a point where the central bank is going to ease and start to manipulate or stimulate the economy. That then kicks us into the artificial market cycle, because they essentially are trying to suppress interest rates. They are trying to stimulate that economic activity. Would it be fair to say that we're at the beginning of the stimulation phase, which could be prolonged? Or do you think that actually when the central bank starts cutting in the way that they're talking about, that means that the runway for the quote unquote bull market or this part of the cycle is still pretty short?
But you could just look into it. This is what they have done before. If you look at 2001 and you look 2007, you saw significant stimulus coming into the economy. You saw M2 actually moving up quite strongly, not just in 2007 and 2008 and 2009, but also into those years. So if the things were so easy that we could just stimulate the hell out of it, and we'll then get an economy that gets going, why would we then have had the 2001 economic crisis? You had a recession, and also the great financial crisis of the 2007, 2009. So people are just not looking to what is really important here. I mean, the financial worlds, they look to the financial worlds, the earnings of the Nvidia and so on, and they look at the liquidity also. But the real economy is about Mrs. Johnson in the U.S. 15.6% of the U.S. population is not able to put food on the table. Everybody is hurt by high rates, high inflation, and we see the job numbers are actually quite poor. So when the real cycle rolls over, then you can forget about liquidity. Liquidity can stem up the tidal wave of an economy that is rolling over, and that is what is happening right now. That is completely different from what we saw in 22, in 23, 24, and 25, and also in later or earlier. I mean, in terms of of any kind of stimulus that's been coming out. This is 2007, where you have a significant structural gaping hole in the economy. If you look to the housing market, it is at a standstill. You have existing home sales that are at lower levels than when the population were 100 million people fewer in the US. So this is about the real economy versus what you have, what I call the liquiditatists thinking that is, as long as you get liquidity out there, everything will be fine. You can get a eureka moment. And I'm also talking about that you are not at the top yet. And I see Bitcoin and I see other cryptos moving much higher here. But that's not the same as the real economy. And the real economy is rolling over at this point. And that is the problem. And I think people are not really understanding what this means. There's no indication of an early phase here. And the artificial part can work for as long as you are in a deflationary environment. Remember, inflation has been reintroduced. We now have people expecting inflation to go up. So if you're Mrs. Johnson now and you get $100 saving on your mortgage loan or whatever it is because of, artificial thing, will you go spend that money immediately? Or will you actually save it for a rainy day, having looked at yield rise, rate rise, and you looked at inflation and so on and so forth? I say that the time for the easy lunch, free lunch from the Fed and whatever is coming to an end. Will they try? Yes, they will, but they are not going to do it. They cannot sustain the tidal wave of the real economy, and that's the problem.
So what you're really describing here is kind of this K-shaped economy, right? You have people who own assets, who have been exposed to the stock market, Bitcoin, gold, et cetera. They've done very well. I think a lot of people think they will continue to do very well. You are talking about kind of this real economy, or the lower part of that K, where there's a lot of people who either because they don't have assets, or frankly, even if they do have assets, they still are struggling to put food on the table, afford mortgages, do kind of the everyday actions. Now, I think that there is an argument to be made where over the last 5 years in the United States economy, we have had 3 different bear markets. Now, that is a stock market bear market. But during that period, we basically had 2 pretty catastrophic external shocks to the real economy. The first was COVID, which was, hey, lock everyone at home and basically put the velocity of money down significantly. The second was this whole tariff thing where we saw companies definitely slow hiring. We saw people start to change their consumption patterns. Like there was a period of time where people are very, very worried. Does it have to be something that is catastrophic, that's external in terms of like a pin popping this bubble in a way? Or can it be a slow grind into a market turning over and we end up in some sort of recessionary period, but there's no one thing to point to that really is the catalyst to get us there?
The real recession, they don't come with a catalyst like what you described just here. So we didn't have a recession when you talked about the tariffs. There was not a recession, it was a pullback. And it was quite clear, actually, because if you look at the business cycles, there were no evidence of a recession at that point. The leading indicators, the coincident indicator was simply not, weak enough to get to that point, which I also pointed out on X at that time. If you look then to the situation around COVID, we actually had a slowdown before that. So if you look at COVID, the recession would have come anyway. What happened actually was in 2019 and 18, you actually saw how yields were already declining, and we had a recession indicator signal from the leading indicators. So that was a different case. But what we're looking at is exactly as you say, we don't need that kind of thing. What was the real big thing back in 2007 in October when the market topped out? And then people say, oh, yeah, but that was the subprime. Guess what? You didn't have any big catalyst at that point. There wasn't anything in October of 2007. The market just topped out because what happened is that the environment gets so toxic that the consumer starts to spend less. And if you look at it, you'll actually see how the unemployment rate starts to move up, or not just the rate, but the number of unemployed people starts to move up. You have a lot of leading indicators there showing that things were actually, unfolding in a bad way. You also had the leading indicators. You had yield inversions all over the place in 2007. So these are the things that you will see before prices unfold. You did not have that one, yield inversion into 2022, into the tariff situation. So the situation is simply that we don't need that catalyst as you talked about there for having the recession. It is the environment that becomes toxic, and that becomes a problem for the economy. And all of a sudden, the bubble bursts.
Let's talk about the investor kind of economy for a second, really in these asset prices, whether it's stocks, Bitcoin, gold, et cetera. I have seen you talk about this idea of like a blow off top in risk assets. Talk through what is a blow off top in risk assets, and do you think that's what we are kind of setting ourselves up for through the end of this year?
But if you look at the S&P, I mean, just look at where we were in April and how far we have come since then. Look at where we were in 2022, and in October 22, we were at 3,500. Look at the rate of the move we have seen since then. This is by definition the blow-off top. This is by definition. If you look at how fast it's going, it is unprecedented compared to what we have seen, in previous times. Nasdaq is up 21, 22 times since 2009. Just think about it. We have right now a market capitalization, which is at 216% compared to 2007, where it was at 109%. And in 2000, when we had the dot-com, which was crazy bubble, we were at 136%. 1929, we were 89%. We are now 3 times on what we were in 1929. We are almost double what we had in 2000, which was a crazy bubble. So I don't know what people want to see. We have a complete crypto market, a whole crypto market where a long range of them are jokes, but they are valued at extreme levels. So people saying, where is the blow-off top? Well, you're sitting right in it, and it can go even more crazy. So I'm talking 7,500 on the S&P, maybe even more crazy, but we are getting closer to it. And we're getting closer because you're seeing the real economy roll over. There's nothing remotely close to an early phase here. This is late phase, and you don't see a bubble like this. Look at NVIDIA compared to what you had back in the day, Cisco. Cisco was the greatest bubble in 2000. It is dwarfed by what we see in NVIDIA. So, and then people come with the AI narrative and all that. This is .com all over again. Even on the housing market, if you look at the housing market, the housing index, Schiller Housing Index, is showing us that we have a bigger bubble than we had in 2007. So that people are telling that this is early, I mean, just do not look to the facts. So I can see how this can go on for such a long time. And especially if you look at how, underwater a lot of people are when it comes to the US economy, what is it really that should bring them, continue to consume here?
Let's talk about valuations, because I do think that this is pretty interesting. You mentioned that the stock market is 3 times higher in terms of the percentage than it was in 1929. I would argue the companies are 100x better than the companies then, both in terms of efficiency, productivity, performance, growth rates. I mean, all these different metrics, the companies today are much, much better, and therefore they should be valued at a higher rate. They can grow faster. They can drive more profits. Thinking of a Facebook, of an Amazon, the scale, the speed of these businesses. Now, I don't think
this is related to the U.S. economy. So
correct.
all of a sudden, what you're saying is all of a sudden that the stock market will be 3 times as big because of that we have companies that, just do better. I mean, everything is relatively here. What is then the top layer? What will be the top there? I mean, historically, we haven't seen this above 75 to 85, and now we are 226. If you take the crypto market in, we are 226%. So the historical average is like, 1/3 of where we are now. And the tops in 2000, where we also had this narrative of, we have these fantastic companies, we are, moving in on doubling of that size. So I just don't get the argument here really, because it's always relative to an economy, and
Well, I think that there's a couple of things that are at play, right? First of all, we have much more concentration because the businesses are better. Like if you look at the top 10 companies in the US economy, they're probably the 10 best companies ever constructed in human history, right? In terms of what they're able to do with the size of the team, the productivity, the revenue and profit. That doesn't mean we can't be in a bubble. That doesn't mean they can't go down in price. That doesn't mean that they can't be overvalued. Like all the things you're saying, 100% could be true. But I'm just saying objectively, if you look at what these businesses have been able to do with the technology they have, it is unlike anything that we have seen previously. Now, with that said, I think that there's also this underlying technology component. And I am always trying to balance. I look at the data. I got a lot of smart people that work with us. They show me this data all the time. And I sit there and I say, like, I can see, hey, man, you don't got to be Albert Einstein to see the chart is higher now than it was in 2001. That don't look good, right? At the same time, I can pick up my phone and I can press a button and Jeff Bezos is going to deliver me something by tonight. or I can press a button on my phone and food's going to show up in 20 minutes.
Guess what? 1920s, right? You just had the electrification. You had the car coming out. Try imagine you could just turn the switch and you could then get light coming in your room. Or you could jump into something which has 4 wheels on it and automatically you could start driving, running, going down the road without having horses in front of it. So imagine, did that actually give you that were not in a bubble at that time in 1929? It did not. So the promise from a technology is not the same as you cannot have an overvaluation of things. So what you're describing there is absolutely true, but you have seen this before. You could also see it in 2000. In 2000, we saw the internet coming out. Did that not change the world? Completely, it did. We saw that all these fantastic ideas on how we could actually start to, do trade. We could trade online. We could, buy stuff online. Change the world completely. I'm sitting from home working today because of the internet. Did that actually not turn into a bubble as well? It did. So the technology by itself does not promise returns. It tells you that the world is going to be changed and is changing, but it's not the same as saying we can now sustain artificial, exuberant high levels. And that's what you're suggesting.
No, I think there's 2 different things here. So one is the technology today, everything that you're describing, the internet, all these components, right, was basically technology that was helping from an individual perspective. And if you go back and you look, how many of the companies were actually driving, like the Facebook latest earnings report just blew my mind. You have a company that is valued trillions of dollars and is growing 20, 30% year over year. Revenue, profit, right? I mean, not like, hey, my user base is growing, which can be gamed and nonsense, et cetera. We are now seeing companies that are growing at a rate, given the scale that they have, we've just never seen before. And again, it goes back to, it doesn't mean that there can't be a bubble. It just means that it becomes very difficult. So one input for me in this framework of trying to figure it out is, okay, we have a scale of company that is able to grow at a rate that we just have never seen before. Does that mean that it's better or worse, overvalued? Not necessarily, but it's just like that is one input. The second thing is we now are seeing the dollar debased at an accelerated rate. So it used to be, if you go back to 1971 to today, it's about a 4% debasement annually since 1971. Since 2020, we have now seen the US dollar lose 29% of its purchasing power. So obviously it is happening faster, which therefore should be pushing these valuations higher. Again, doesn't mean there can't be a bubble, but I try to think through okay, there's all these inputs that are different than what we've seen.
If you said the last one, if you just, and then go back to the Buffett indicator that I said, if you have that should influence everything in the economy, which means that it should then, equal out what's happening on the one side. So if you say that everything is growing by 4% because of the dollar debasement, well, the entire economy should grow by that, but because of that. But that you're actually seeing that this is happening just in a few companies and we have the concentration that we have should start to trigger our minds and say, hey, maybe something is wrong here. And I don't quite follow that, in terms of the productivity levels here. I can tell you the productivity levels of getting electrification back in the 1920s or the assembly lines were quite remarkable. And it's just because we now like to say, oh, we can see this now, and the money's flowing in. What you have right now is that you have had the largest experiment ever in terms of trying to stimulate through monetary easing. This is an experiment, yeah. And with that, you can see obviously that can push things up further and further to a breaking point. But you cannot print wealth. If it was that easy, you would simply at some point see that breakdown. But until that moment goes, you can actually see that things can just explode into, valuations and so on. Because what happens by the end of the day is that they have been suppressing yields. If you suppress yields, you'll then see that your cash flow looks fantastic because what you can get on the secure side in the bonds and so on, you don't want to go there because who wants something that yields 0? So you go with the 1% or the 2%, which means you have a fantastic distortion of things. And then the narrative starts. What if we have this new thing coming called crypto or called AI? And then the whole narrative goes. We have seen it over and over and over. You saw it in the 1840s when you saw the railway coming out. I can tell you that was one thing that brought about productivity, because now you could actually transport things from one area of the world to the other area of the world, in the US as well, and in the UK. But it was still a bubble and it burst. Technology does not guarantee returns. It tells us that the world can change, but it also tells us that people will try to front run this with all sorts of arguments saying, this time is different because this, and that. We've heard it over and over. It was different in the 1840s. It was different in the 1920s. It was different in 2000. And it's different again now. I just say it's not. And the way that we back in 2000, when we were told that this is new economy, and it's not about how much you actually earn, it's about how much you spend. That was one thing we also heard on promotion, on marketing, and so on. We just hear those narratives change. But the thing is, deep down, we see that the valuations are at extreme levels, and we have never seen them at these extreme levels here. And this time around, you not only have a bubble in tech stocks, you have a bubble in the housing market and tech stocks. So this is 2000 and 2007 meeting each other on drugs.
Today's episode is brought to you by Citizenship. If you're a Bitcoiner thinking about global mobility and securing a true plan B, listen up. Portugal is one of the most attractive golden visa programs in the world, and Citizenship has built the ideal pathway to get you there. They're behind the first Bitcoin ecosystem golden visa fund. It's a private equity fund that purchases Bitcoin via a local company. That gives you exposure to Bitcoin while qualifying you for the golden visa and citizenship in just 5 years. Plus, here's what makes this a no-brainer. Citizenship has the lowest fee structure of any golden visa fund in Portugal. And because their team handles everything in-house, you skip the usual friction and bloated fundraising costs of other funds. So if you're serious about sovereign flexibility, now's the moment to act. Go to citizenship.com/pomp and book a free strategy call with their team. Again, that's citizenship.com/pomp. Go check them out today. So let's back up for a second. I agree. The most dangerous words, or this time it's different. But I also think that there are things that are different, right? In terms of post 1971, obviously the dollar being debased. That's different. Seeing the QE playbook that central banks roll out whenever there seems to be shakiness in the market or a downturn, that's different, right? How do you as an investor think through, there are certain things that are different, there are certain inputs that are the exact same. You look at a valuation chart, you look at some sort of, a market call. How do you sift through all this information? How do you determine when to acknowledge the things that are different versus just say, hey, look, historic valuation levels, this is what they've been. If we're super elevated from that, we got to be near some sort of top.
Human psychology will always be the same. Human psychology will always be the same. We will always think that this time is different. This time we are wiser. That's the only thing that is really, that's the basics of everything. And of course, technology changes, and we will see that there will be, lifts in the market because of all of that. I'm not discarding that at all. I'm saying AI is going to do the biggest change to the world that we have ever seen. AI is going to be fantastic. It's going to change productivity levels and so on. But the fact is, when we look at data, when we look at things, and from the normal things that we always see the return to, people were also telling us in 2007, why would we have a bubble in real estate? We don't see that. The real estate can't really drop on a national wide level. Actually, it could in the whole world. We saw in 2000 the same thing. We saw the .coms. Well, it's different this time. It's about the internet. You have to understand that. The vast majority of these companies, they do not exist any longer. Webvan, Pet Shop, whatever they were called, they don't exist. They were darlings of the Wall Street back then, and also of the media. Everybody talked about that. I think it was 16 or 18 of those, the commercials that were in the Super Bowl in 2000, they were actually not existing a year later. So this is the moment where euphoria is big. It's because we have seen all this money coming in, and then we think it can go on forever. But if we think that liquidity can drive things, why did Weimar Republic all of a sudden have big inflation and you had a crush of the stock markets? Why is Zimbabwe not a thing all of a sudden? Why are all these countries that have been so just pouring money into their economies not doing well? Because money cannot be printed. Wealth cannot be printed. You can print money, but you can't print wealth. And there's a difference between that. There will be an artificial period where you'll see people think this is wealth and it's going to be here forever. And people will flock into more and more risky assets until the bubble bursts.
So
this is what we see again, as I see it.
Let's say that you are right here, right? What do you think plays out over the next 12 to 24 months? Walk me through kind of, okay, we're overvalued. We're in a bubble. The bubble will pop at some point. What happens? What is your kind of base case right now?
So right now we're seeing that the environment has been very toxic, I would say. And the toxic is when you look at the real economy, which is the consumer. Talking about, again, as I said, 15.6% in a new study shows that 15.6% of the US population is not able to provide or to get food on the table, which is a severe problem. That's bigger than going into the financial crisis, which was at 13%. When you look at the yield levels that people have, the rates that people are paying right now, if you look at the housing market, the existing homes sold, it is, as I said earlier, it is at very low levels. It's 4 million units sold in 24, and at this point it's lower than that. And in a population that is now 100 million bigger than when we earlier saw 4 million. So things are at a standstill. You have affordability index. It's down the gutter. It's lower than in the 1990s. Well, we need to go back to the 1980s where it was really a bad time. These are the things. This is the real economy, and everybody seems to think about what Nvidia and you talked about Facebook or Meta and so on. These are the things that are being driven by liquidity, and that is the big schism here. Will liquidity by the end of the day drive it, or will it be the real economy? And what I'm a proponent of is that the real economy is rolling over. There's 100%. You can look at all the indicators. Look at the non-farm payrolls revision today. That is not a good thing. You have had in May, you had a standstill almost already in non-farm payrolls. In May, June, July, the same. This is not a good thing. So the economy is, and what will happen? Well, at some point, you're going to see that we'll start to see that the economy is rolling back, and that will be on the labor market. You start to see negative numbers coming out. And what the Fed will do is that they will try to stimulate it at some point. They'll be late, and they will see that they cannot do it, because by the end of the day, we have to understand the only thing that will help if the consumers start to spend more. What should they spend if 15.6% can't put food on the table? And why should the companies start to hire people in? They have overcapacity at this point. The capacity utilization in the US right now is at 77%, which normally when it goes below 80%, you'll see that they start to lay off people. Where should the money come from? And then we say the Fed. Well, as I said, Mrs. Johnson now, she saves $100 on her mortgage loan. Will she go out and say, okay, I'm going to spend this, having seen inflation, having seen yields go up, having seen maybe her neighbor getting laid off or her husband or whatever. And then she says, you know what? I'm not only going to spend this one, I'm going to borrow an extra $100 and then I'm going to go spend those two, putting myself into more debt when she's already more in debt than she's ever been before. There's nothing that supports the argument that QE can actually keep supporting an economy and the economic growth, especially when you start to see it really coming into the real part of the economy, which is the consumer, and that we do now. We haven't seen that earlier. I was not one of the guys talking about recession in 22 or 23 for that matter. I said, no, not this time, because we still have the cycle still moving higher, but now it's rolling over. And in the next few months, we're going to see the non-farm payrolls getting worse and worse. You'll see the blips up and down, and then they'll be revised and so on. And all of a sudden, you'll see the stock market will put in the top. It can be at a very high level, and you can see the euphoria develop, which is, I think, we're going to see. You think Bitcoin can go to 160,000, and you'll see people be euphoric and thinking, okay, I'm a billionaire or a millionaire, or how much they will become. And everything is fine, but that's actually not fine. And it's not fine that the central banks are starting to ease, because that they only do late phase and late cycle, because they are always late and they can't save it. And you saw that in 2001, you see it in 2007, we've seen it every time we had late phase, late cycle, they are late.
You mentioned Bitcoin. If the 4-year cycle holds, then the market top would be in Q4 of this year, right? About 18 months post halving. You have a strong Q4. We've seen this time and again. There is an argument that the ETFs, the digital asset treasury companies, kind of all these market changes, the introduction of Wall Street has changed the 4-year cycle, that is no longer going to be a thing. Bitcoin should continue to kind of grind up. So you won't get these blow off tops, but you also won't get the 80-85% drawdowns. What do you say to that?
This time is different, first of all, which is not. So I don't buy that. It's the narrative we hear all the time. We hear it again and again. This time is different. And then something comes up, and then we see that it's not different. The cycle, probably holds. And I think, within the next 50 days, you could probably see a top of the Bitcoin, and it could be a much higher level, as I said, than where we are now. But I also see that the business cycle rolling over at this time. So that's quite different. And I think that what I see technically in Bitcoin, that this is a massive top you have here. This is not a cyclical top. This is a secular top in Bitcoin, which means that we are you can see it's crashing to much, much lower levels than most people can understand. So this time is different with the ETFs and all that. Take the .com, narratives and put it in and put the digital, sprinkle on it, and you have the narratives of today. It's really about the real economy. The real economy is rolling over, and I cannot emphasize that more. When it does that, there's no going back. The risk asset, and Bitcoin is a risk asset, will crash. So you're going to see Bitcoin is going to have a very good time for the next few weeks here until the top, and also with the cycle. And then I think it's going to be a really, really bad asset to hold for the next few years. And then we'll have to see, because I can only see down the road that the Fed will come back in again. But if you look at it, what they have done is, as I said before, they have reintroduced inflation. What do I mean about that? If you look at a chart, a 10-year yield chart for the last 100 years, you can see how the cycle goes up and down in terms of yields, which follows inflation. And if you look at it, you can actually see momentum-wise that it shifts in 3 phases. So from the 20s until the 70s, after the Second World War into the 70s, you had an inflationary trend. Then Volcker came out and you had a deflationary trend. And now we are actually at the bottoming end of this, and we see that we have a significant shift in the momentum. That's why the Jeff Gonklacks and so on are telling us that they're going to short the bond market, because in the long time frame here, they see that yields will go higher. If that happens, you are in a completely new setup from what we've seen over the last 5 to 10 years. You are now in an inflationary environment. I mean, just think about what our grandparents would say or our parents would say back in the 70s. If you said, you know what? Every time the economy rolls over, we'll just the tiniest bit, we'll just sprinkle some liquidity on it, a lot of it actually, and more, and everything will be fine. You know what they will tell us? They will say to us, how can you do that? You'll get inflation. Why would you do that? Then you'll get inflation. You'll crush the consumer even more. And this is what people do not understand. That is really what is different this time, is that we have reintroduced inflation with the stimulating into COVID in a crazy manner when the supply chain was actually breaking down. That was the inverted Volcker moment, which reintroduces inflation on a secular basis. And in that world, you cannot sprinkle liquidity on everything and just get a better outlook. So I think you're going to see the Fed come in and, excuse me, and then they will try to do the same thing again, but they're going to find out that the free lunch is over. The free lunch is over now. There's inflation that actually will kick up, not immediately. They may do a bounce in the market and the euphoria may come out for some time. But in the longer time frame, I think you're going to see something that is much, much worse. And that is an economy that is not reacting to stimulus, because Mrs. Johnson there, she doesn't go and borrow that $100 extra. And that means that the stimulus packages on the QE side will not help. They will not be as stimulative, and they will not really help to turn the economy. But what we'll see is that the money that starts to be injected will start circulating faster, and that creates inflation. What is your base case for where inflation could go? Right now, government numbers are just under 3% to 2.5%, 3%. Something like the Trueflation has it down around 2%. We're at 9% during COVID. What's kind of the thought process or trajectory for that inflation number? But they are on a decline right now. That's what happens when you have the leading indicators, the coincident indicators. So when the real economy rolls over, you'll see that inflation drops as well. That's why they're going to drop, and they're going to drop a lot. Because if you look at also inflation, and you look into what we had in 2001, 2007, and also before that, when Fed was stepping back in, inflation levels were at much, much higher levels. Actually, in 2007, we were at 2.7% in September 2007, and then it moved up, and the Fed started stimulating aggressively And they did that in an inflationary environment. Right now, we are already seeing that the Fed has squeezed inflation from at this point on. So I think they are so late in this, what they do now, and that you're going to see a deflationary phase, but they're going to come out with their guns blazing. And I can tell you they're going to come out big this time, because when they start to face that, what they should have seen long ago when they were asked on a Fed presser, there was one, intelligent journalist, they're actually saying, so why is it that, the consumers are not really, agreeing with you when it comes to, how great the economy is back, 6 months ago? And he was saying, yeah, but it's because of the tariffs and so on, and this, kind of thing. What you really was seeing that he didn't understand that the consumer is everything. And he needs to understand that when the consumer is bad, the economy is going to not feeling well. The economy is going to turn bad. That is what we see now, the slow phases of that. So I think you'll see inflation dropping a lot this, the next few months here. We don't have an inflationary problem that is so spoken up. We have a deflationary pressure that is quite significant. Look to housing and to rental and so on. These are the big stuff, and I like what Truflation is what they do. And then you'll see the Fed come out and they reintroduce, because you have now a new cyclical or secular bull market in that, you're going to see inflation come back up again. And it's going to go much, much higher the next decade. So everything we know about investing that we learned over the last 10, 15 years has to be reshuffled. And we need to understand that we are now in the late 1940s, and we need to look into a world that's going to be quite different from what we've been looking at so far.
Today's episode is brought to you by Xapo Bank, where eligible members can unlock the power of Bitcoin without selling it. Need cash fast? With Xapo Bank's Bitcoin-backed loans, you can access 40% of your Bitcoin's value, borrowing as much as $1 million for a full year with low interest rates, zero fees, and no early repayment fees either. Now, here's the best part. You keep your Bitcoin, meaning you get to watch your holdings grow as the price of Bitcoin increases. Whether you're looking to buy a house, fund your child's education, or seize an exciting investment opportunity, these loans give you the flexibility to access cash without selling your Bitcoin. Unlike traditional loans, Xapo Bank's Bitcoin-backed loans have no minimum repayments, no early repayment penalties, and the flexibility to settle your loan in USD or Bitcoin whenever it suits you. It's liquidity entirely on your terms. Xapo understands the unique needs of Bitcoin holders. That's why they have developed a product designed specifically for you. With over a decade of experience in the Bitcoin space, Xapo Bank has been a trusted partner for those looking to make the most of their Bitcoin while keeping it safe. Your Bitcoin stays safe in your vault, untouched, never lent out, and secured in a global network of military-grade bunkers with cutting-edge security technology. Head to xapobank.com/pomp to learn more. That's xapobank.com/pomp. Go check them out at xapobank.com/pomp today. If you were talking to, a child, and you were to explain, okay, here is the framework that you need for the next 10 years to be a good investor, what does that worldview or that perspective look like? Are there like 2 or 3 key principles that you're paying attention? You mentioned higher inflation over the next decade. You mentioned this idea of the economy not responding to the stimulus that once it did respond to. Just what are some of those things that you think are kind of critical understandings to be able to navigate what's coming for the next 10 years?
I think it's critical that we study and understand where you had to invest if you were in the 1940s. First of all, we're not going to, we still have the big shakeout thing. So we're not really in the 1950s phase, but coming that big shakeout that I think we're going to see in the markets and so on, you'll have to study what we did. You should have been investing in the 1950s when you had an economy that was starting to grow again. But we are not really there, and that's why I think the whipsaw effect of what we can see now is going to be quite difficult to navigate in. I think you're going to see now the blow off top. Everybody will be a genius because they are long Bitcoin or long some crypto. And then they will realize that there is a top to these things, and they can actually crash quite a lot. And a lot of people will be not so happy about that. And you can see yields coming down strongly in the deflationary phase, the dollar strengthening to extreme highs. I mean, I see in that phase the dollar hitting 117 on the Dixie, 120 even. So it'll be a lot of headwind. And then you'll see the Fed coming in, trying to crush the dollar, and they will be very, very, very successful. And then you'll see it'll be completely different. So it depends on where you are in these phases. And the first phase, the first deflationary phase, it's not going to be years. That's what I'm talking about. I'm talking about 6-9 months, but it's going to be severe. But the next phase, when they come in, they step in, and the stagflationary part, which is when inflation starts to move up and the stimulus is not, when inflation starts to move up and stimulus doesn't really work, well, that is the phase which will be very difficult for a lot of people. And the only thing that really will do well there is hard assets. It's commodities. It's gold and silver at that point, which may not do so well in the deflationary phase. And then we need to see what happens after, because I cannot see how this ends without a monetary reset at some point, where they simply clean up this mess that we have right now in terms of money printing, crypto all over the place, and speculation about what will be the next foundation for the global financial system, and so on. It will not just be left up in the air. It cannot, because by the end of the day, we need a sound monetary system to build things on. 1944 was the turning point after the Second World War. Debt was ballooning and so on. We needed a stable foundation. The US came out, said, hey, we have half the production of the world. We have half the gold reserves. You will be able to take our dollar bills and you can transfer them into or convert them into gold any day you want. That was a stability. That was what the world was looking for. So we could use that to trade and to go forward. That kind of cleanup is needed before we really see the things going. The world starting to grow in a real manner again. Because what we have seen over the last many years are stimulated growth. Now let's pump money into it. Stock prices goes up. What's not to like? Well, look at the consumer. They don't like it. And that's the real problem.
You mentioned a monetary reset, and I do think it's pretty interesting. There's been multiple times throughout society, both globally and domestically. There's obviously Bretton Woods and many of the things that kind of the Bitcoin and gold community talk about. But there's also a time in America, well before that, where pretty much anyone running around with a money printer created their own currency, and there was local currencies, state currencies, there was private illegal currency. I mean, it was chaos.
Yeah.
Kind of sounds like crypto a little bit, right? Like there's an element of like anyone can,
not a little, a lot, I think.
Yeah.
Yes.
Yeah. Like anyone can create a coin, right? And so like it was, all this stuff going on. We eventually figured it out, and there's plenty of critiques of the system, but I do think that everyone kind of like got on the same page and was like, all right, like the dollar is the national currency. Mm-hmm. It's illegal to create one that competes with it inside, the United States. Here's how the dollar is going to interact with on a global basis, these other national currencies, whatever. What does the monetary reset that you see look like going forward? Or like if you were in charge, what would that be?
Well, first of all, we need to stabilize. We cannot have a system where if the basic of all of this would be we need trade to get to start working again. We need to have trade amongst trading partners of the world. We need to have a stable, functioning currency system that the people trust and will hold, because they know it's not just going to be printed into infinity. And so there needs to be some, checks and balances on that. That we have completely, and I agree with you, since 1971, it just, completely left that off. And I think we could maybe see even a worse situation if, we get now a close connect between the US administration and the Fed chairman. And there's not this disconnect between it, which could be in the air and coming into next year. So we need to clean it up. Completely agree with that. And the thing I would say, it would be deep down, it would be about gold. And I think that is the reason why you see the Asian economists of the world, they buy it up big right now. They understand where this is heading to. They, at some point, will have to say, show me yours and I'll show you mine. And then we'll look at whose pile is the biggest. And then we'll, agree on some kind of system that where gold will be kind of a backing to it. Maybe in terms of how, the leverage or how much the weight of a certain country should be. Because nobody actually likes apart from us in the Western world, we've been thriving on the US hegemony, but the rest of the world, the BRICS countries and so on, they don't like it. And it's also been misused, I could say, from their point of view. I mean, we have been benefiting from here in Denmark, so I'm not complaining. But it's but it has been misused. We have to be honest about that. And that's why I think you're going to see if we're going to bind up collect or combine the world, you will either see it reset, which has a digital component to it, and then gold down beneath. And then the checks and balances in terms of how we trade with each other will be the digital part. But there will be gold actually showing how much is your currency then, a part of that scale. And then you'll see that there'll be a new global reserve currency that, has this will be a basket of something. I think that's the future. And it will have a digital component because that'll be the way where you can start working trading with people in foreign countries without being too, when it's not so difficult any longer. You just, the checks and balances of who owns what and where the dollar went and did not go will all be in the ledger, in the blockchain. And I think that is what we need to get to. That is the real end scenario of this, that when we have that, then we can see things are starting to grow again, that after the Bretton Woods, and we have a stable currency, stable monetary system, because we definitely do not have a stable currency system at this point.
The last thing I want to talk to you about is either your portfolio or like a model portfolio. There's a lot of volatility and uncertainty that seems to be coming. It's hard to navigate because there's assets, there's timing, but there's also kind of these unknown potential levers that can get pulled from politicians and central bankers. And you know that they have the tool in their toolbox, but you don't know when they're going to use them or how severely they're going to use them. And so, COVID was a great example, like 2 emergency rate cuts down to 0. Game board changed real fast and you had to figure out, what you were doing. How are you positioning or talking to people about positioning their portfolio to be prepared to kind of navigate some of this, knowing that it will change through the scenarios, but like, what does it look like today?
So there's one thing, what I do myself, how I personally handle my own funds, and then also how we talk to clients and what we say, and also again what people that has bigger fortunes, like Warren Buffett, he does it. He's been pulling his money out, and he's in a record cash position compared to his assets. So I think it depends on how risk adverse you are, and I would say that navigating, as I said, in this whipsaw kind of environment where you can get first a blow off top, a deflationary bust, and the Fed comes in, and all these stagflation maybe also, it'll be so difficult. So there may be some will say, well, I want to ride it out. What should I do? Then probably if you ask me that, which should I just buy now, hold on to? I would say gold, even though I think gold has had a big pullback in deflation, in a deflationary bust. But in the 5-10 years time frame, I wouldn't be worried. It would be gold. And you could just look at the SPX versus gold. Actually, it's now breaking down. We've only seen 4 times in history: 1929, 1971, and 2000, and now it does it again. But that's for another day. So you have these. But there will be less. Sometimes just having cash would also be good, and just having having 0 on your minus the inflation, of course. So the bill be deflated away to a certain degree, but just having cash could be a good situation for some people. So it depends on their risk appetite there. Mine personally, well, I have a lot of risk assets here because I think I will still be able to pull it out in a good time. I don't think we have the top, anywhere near the top here. I would say time wise closing in. But the final phase of it can be so steep that most people will not, really understand how steep it can be. So I think I'll be selling into that. Other people may find it right to take the chips off the table now. Would I be in any kind of anything that is related to crypto? Absolutely not. Absolutely not. I mean, Bitcoin has crashed 4 times by more than 73%, while NASDAQ was down 18, 20, 25%, 30%. Bitcoin was just, crushed. If I see a tech bubble, and there is a clear tech bubble here, and we're going to see the NASDAQ declining by 85%, just like what we saw in 2001, and this bubble is bigger, I wouldn't be in that. So I think people would need to be careful here in terms of what they see with Bitcoin. And if you look at the long-term chart also, you can see that there's a clear divergence on the weekly, which tells us that a bigger top is coming for Bitcoin. Not here. I think it's going much higher. So it will be a difficult landscape to navigate in. One asset would be gold if you had to hold it on through it all. If not, well, some cash would be good as well. And maybe, even hold the dollar. I'll be going long the dollar as much as I can. When I think the top is in, because I think there is a shortage of dollars the moment you start to see deflationary bust going, and the restructuring processes and so on will simply demand dollars to get settled. So that will send the dollar up strongly, and then after that, well, it'll be commodities and gold and silver and the likes, because it will be in a time of stagflation where you see these hard assets will start to perform really well.
What would have to be true for you to change your mind. And you say, you know what, I thought this was going to happen. I thought this, kind of correction was going to happen. I don't think that anymore. Is there anything that, like one thing you could point to, or is it just a collection of data points that would all have to improve?
I have the business target model that I have is not just based on one thing. So you can, that's would be the weakness of anything. If it was dependent on one thing, then, everything would collapse. So it's dependent on quite a set of things that we need to change, First of all, you need to see that the yield levels, the rates are coming down quite strongly because people simply cannot afford the yield levels that we have right now. At the same time, we cannot see that that businesses start to lay off people. So if we can really get the soft landing, which we by no means have at this point, because the unemployment numbers are still rising nice and steadily. I'm not talking the ratio because the rate, because that is also affected by the job market's participation. But if you're looking at a number of people unemployed, it's moving up nice and steadily, and if that could stop, and we could see the yields coming down, then I would say, okay, this may be different. Then I would think also we would need a healthy pullback in the stock market still, because I don't think we are anywhere near, we haven't seen anything that is healthy at this point. We've seen extreme rallies. So a healthy pullback, and then maybe, but it's really about down to the real consumer to get them back in the game, to see the housing market starts to actually accelerate or just, move up from the gutter, affordability moving up, then things could change. But I just don't see how that can happen without a bigger bust. And I actually think we are already, the Titanic has hit the iceberg. There's not much to be done at this point.
I think that's a great place to leave it. The Titanic has already hit the iceberg. If you don't know what happens, go watch the movie. Henrik, thank you so much for your time. Where can we send people to find you and find SwissBlock as well?
Well, go to @Henrik Zeberg on X or to swissblock.net. You can also find us there, and reach out if there's any suggestions. I always like a good chat or a good conversation with if there are good arguments. So thank you for today as well. Also,
absolutely. I think that you're going to be requested to come back with the thoughts and insights you brought today. So I appreciate it very much, and we'll definitely do it again in the future.
Thank you.